Now, we're hearing the market is slowing down, yields coming up. What are your thoughts on this?
It's actually a mixed reaction in the market. At the last auction, which was done in in September, the 5 years and the 7-year bonds actually printed higher than what secondary market was doing at 12.9 levels. And since then, we've seen quite an aggressive reaction in the secondary market, mostly being driven by the locals selling those bonds in the secondary market. Then again, on the back of the launch of NGM bonds at the JPI, the expectation was that we're going to see a lot of funds coming into the system, thereby pressing down the yield again. And as that reaction was not seen as much from the locals, we saw a lot of panic tradings and we saw a lot of G3 sell-off in position. But from our own point of view, I think generally a lot of people actually misconstrued these ideas. The fact that we're expecting so much demand after the launch of the JPI, after the launch of the NGM bonds on JPI, doesn't mean that the funds are going to come in immediately. Don't forget, before now, we've seen an aggressive buying in the market, which moved the yields probably from around 14 levels to 12.25, 12.5 levels. But again, don't forget that these funds are actually coming from most hedge funds. And going forward, after the launch, we expect to see some of the real funds coming to the market. And that interest is going to be gradual. So something that's going to happen immediately.
Well, Steve, I mean, like you're saying, currently yields around 10%, 13%. Going forward into next week, where do you see them going? You're saying possibly with the auction coming up next week, with this new circulation of maybe 10-year bonds coming into play, we might see them going back up. Where do you see them going, up or down exactly?
Well, if you look at the curve right now, you see the 5-year trading at 13.8 levels and the 7 and the 10-year trading at around 13.6 levels respectively. The auction next week is going to have 5-year in small circulations, about 15 billion on offer. And we have the 7 years and the 10 years in 30 billion each. From what we get during from the offshore investors and even local PFAs, I think going forward you're going to see gradual inflow of some of these funds coming through the auction. A lot of them actually slow down, looking at what secondary market is doing and trying to see if they actually could nibble in to take the opportunity at the right times.
So basically, in terms of activity, in terms of yields going up, you expect them to hit around 14%. In terms of activity, what do you expect? Do you expect it to be quite active?
Well, we expect an active secondary market, and we expect quite a lot of volumes pursuing the primary windows too. So in terms of yield, I'm not too sure the 5, 7, and 10 years are going to touch 14% levels. The secondary market has seen that reaction, and we've seen resistance being pulled up at 14% levels. I think for the 5 years, we actually might see a level around 13.5 levels. And for the 7 and the 10 years, actually might see them range between 13 to 13.25. But again, in terms of supply on the 5 years, and coupled with the fact that if there's so much demand coming through on the 10 years and the 7 years, you actually might see some demand coming through on that side too.
Well, let's talk about what may impact the market going into next week, Steve. I mean, we know inflation is coming out on Monday. Certainly, that may impact the way investors are going to play the market. Inflation is expected to continue to trend downwards. What's your take?
Well, from projection, we expect inflation to trend lower. And if all the parameters actually work together, we expect that actually contributes to much demand seen that we're going to see in the secondary market and the primary windows too. So by and large, we expect to see a lot of demand on the back of the fact that inflation is going to drop, and on the back of the fact that people are going to take advantage of the present blip they've seen in yield.
And Steve, I mean, you know, the president came out, he gave his budget 2013 proposal. And one of the things that came out of that, he said they may reduce borrowing. What are your thoughts on how that's going to affect the market?
Well, that's actually positive news and actually support everything that I've said earlier. If they're going to drop the terms of borrowing from what we're seeing now is about 2.2 of the GDP, which is projected around 6.5 levels. So that means in terms of supply, we're going to see on all those securities next year, the possibility is there that we're going to see a largely reduced amounts being on offer across all those maturities they're going to do. So, and with inflation being projected to be going downward, and the expected inflows coming through from the FDI, and at the same time the exchange rate being stable, then we expect to see interest rate trending lower going forward.
Well, Steve, let's take a look at what's happening on the currency front. I mean, the Naira sort of flat, but slightly rallying against the dollar. We saw it close at 157.15 Naira to the dollar. What is your outlook for our currency going forward?
The currency has been strongly supported by the increase in the reserve, which stood around 41 billion right now. And we've also seen quite a number of inflows coming through the offshore investors, which has supported the currency, and again coupled with some of the sales that have been seen from all the major oil majors. I think going forward we're going to see them a tight range between 157 to 157.50, depending on how the demand we see and depending on the support we see from all these oil sales and from all these dollar sales from oil majors and offshore guys. The possibility is there for a slight appreciation, probably below 157. But again, you see that a lot of players like to take advantage of that when the rate drops below 157 levels, because that means that it's actually lower than the effective CBN of 157.31. So a lot of people actually want to take advantage of that. But again, by and large, if the demand comes through, we see a lot of those flows supporting it around 157.50, 157.60 levels.